everyone, welcome to CAIIB English Medium. This side Aarti and I hope you all are doing good. So if you are also planning for June-July 2025 CAIIB, then this series is very important because in this series we are discussing concepts, along with that we are solving questions also. So you can share with your fellow colleagues also and your bankers also who are planning for this upcoming CAIIB. Because this series is not only for one time, you can use it for your revisions also in your future. So if you are visiting to this particular channel for the first time, do subscribe it, share with your fellow bankers, with your colleagues, so that they also get the benefits of this channel. Because in this, we are not only giving you the concepts, we are also providing you with the strategy, your planning, your revisions, and soon we are going to bring marathons, your mini marathons, so that you are going to get the confidence, like how you are going to attempt the questions. In this particular platform, we are bringing whatever marathons, mini marathons, we are always bringing as per the exam pattern only. Okay, and you already know your exam pattern is very vast if you compare with your CAIIB. Okay, in this you are going to receive your MCQs, case studies, without option questions. So remember one very important point, that this particular channel will help you in each and every aspect for your CAIIB. Chali. So with this, now I am starting today's session because today we are starting with your new module, that is your module C under your ABFM. So this is your unit 13, corporate valuation. Now what is this corporate valuation and what is this module C? Basically module C is totally new module. Okay. In this we are going to talk about totally new things. You might have heard about mergers, acquisitions, one company is acquiring another company. So that thing is covered in this module. But before knowing mergers, acquisition, true meaning, we need to understand few terminologies. What are the methods that we can use it for actual valuation? Chali. So firstly, we need to understand what is the corporate valuation. Valuation means you are estimating value of any goods or any services. That is what valuation means. Now in this, you are going to value the business. That is what corporate valuation is. So in this, whenever you are determining the value of a company or any business or entity, you are going to use corporate valuation. Okay, if I want to know about what is the value of my company, if I want to sell it now, so that is the corporate valuation, in which as a seller I am ready to sell it, and as a buyer he is also going to be ready. We always say value for money. So what is that value for money in case of corporate valuations? That is what we are going to see in this. Because if we talk about seller, they also want the amount, they also want to be in a profit side. Buyer also want to be a profit side. If you are paying not for value for money, then no one will be ready to buy your product. So we need to value it with some, we need to say we need to take some proper factors for calculation. We need to give some proper value techniques also for whenever you are calculating any corporate or business. So that is what corporate valuation. Like today, if Reliance Industries want to sell their Reliance company, then what is their true value in which they can sell in the market? So how they are going to value it, what are the methods? So everything we are going to read in this particular module. But remember, in this, firstly, we need to understand few terminologies. First, like your book value and your market value. So basically, when you want to calculate the value of any product, you can take either the book value or the market value. Now, what is this book value? What is this market value? See, book value is the value of an asset or the complete business entity established by the books or the financials of the company. So basically whenever you are preparing the financial statements, balance sheet, okay, in that whatever amount is written, that is your book value. Whenever we are preparing financial statements, that shows our book value. If you are evaluating with the help of your financial statements, that will give you book value. So book value derived from the balance sheet. Okay? In wider term, you can say in this you are going to use your financial statements. So whenever you are evaluating with the help of financial statements of any company, that will give you the book value. Books of company. So through that you are going to calculate book value. Okay. Now next term is your market value. Market value means term used to describe how much an asset or a company is worth on the financial market according to the market participants. Like if you want to know the true value of any company in the market, you are going to check Bombay Stock Exchange, National Stock Exchange. So in market, what is the true value? How much public or investors are ready to pay for that company? Because you know this NSE, BSC, both the works based on your demand and supply. If your company is having strong base, so investors are ready to pay higher amount. If your company is not having strong base or your company's valuation is not strong, so investors will not pay you the higher amount. So basically you can also evaluate your company's worth based on the market value. In market, how much buyer is ready to pay for you. So that is your market value. So the market value is fundamentally an equity value because equity investors value a company's shares apart from debt lenders and other investors. Under this market value, we are focusing only towards the equity side. So whenever you are going to see the equity term, remember this, who are sharing the ownership of the company. You can understand with this. Not the lenders of your company, not the borrowers of your company. So basically in this, market value is that you can check through your Bombay Stock Exchange, National Stock Exchange, and through that you can evaluate how much in a market investors are ready to pay for your company's share. Through that, if you are evaluating your company's worth, that is your market value. So basically here we completed two terms. Book value with the help of your financial statements, with the market if you are evaluating, that is market value. Okay, one more term you are going to see, that is enterprise value. Now enterprise value, this refers to the value that is placed on a complete company. Okay, this includes your debts and other commitments also. In your market value, you are not including your debts or your other commitments. But under enterprise value, you are going to add your debts and other commitments also. Now you can make one chart out of this. Enterprise value is your total assets. Okay, enterprise is, you can say, as a total assets in which you are adding your equity value also and your debt value also. Your loan side value also and your ownership side value also. When you are including both this net debt and equity value, that will give you enterprise value. Okay, remember, either you can add your all the debts or either you can add all the assets. Both will give you the same answer. You know that how to prepare balance sheet. See, in balance sheet, either you go with liabilities or capital or you go with the assets. Ultimately, your final answer needs to tally. So either you can go with total assets, that is your enterprise value, or either you can go with liabilities and capital, that is your net debt, plus equity value. Because in equity, you were not adding this debt part. Debt is your loan that you have borrowed from public, from bank. So what you can make a conclusion that your equity value, if you want to know, and you have this enterprise value and net debt value, you can easily calculate equity value. Or if you want to calculate enterprise value, you are going to add your equity portion plus your debt portion. This will give you your enterprise value, full value of your enterprise. So this is about enterprise value, book value and your market value. Now under enterprise value, you can use this equity value plus debt for your enterprise value. Now if you want to calculate equity, you can subtract from enterprise value minus net debt. That will give you the equity value. So this is about 3 terms. Now next thing, International Assets Valuation Standards Committee is responsible for developing the international valuation standards. That is your IVS. Now IVS is giving you these standards. Okay? In this International Asset Valuation Standards Committee, they are responsible for developing the international valuation standards. Like we have rules and regulations now. Like if you want to cross a road, you have traffic rules. Okay? If you want to ride a bike, you need to follow traffic rules. Okay? So if you are earning income, you need to pay tax. So every time you are following some other rules and regulations. So like that only, if you want to value any company or any corporate valuation you want to do, then you need to follow their guidelines. And that is given under International Valuation Standards. Okay, chali. Now next thing in this, that is approaches to corporate valuation. Basically under this we have 3 approaches. Number 1, market approach, income approach and cost approach. So these are the 3 approaches: market, income and cost approach. These are the 3 approaches through which you can do the corporate valuation. Chali, under the market approach, firstly we are going to talk about the market approach. Now market approach means what? Under this, your valuation method, this is a valuation method through which you are going to determine the value of a company. Now, how you are going to determine your valuation of your company, of your intangible assets, of your ownership stake in a firm, or if you want to know about the securities value. Now in this, you are going to take the comparable business. Okay. Suppose you want to value company A. Then what is the value of company A? But you don't know. But one thing you have right now with you, that similar type of company A, we have company B. Okay. And there is a recent transaction. There is a recent transaction of this particular company B. So this company is similar to company A. Now for valuation of company A, we can take the help of company B. Then in company B, they valued their assets around this much. Okay, they are also doing the particular type of business. They are also having this much customer base. There is also this much net worth. They are also having this much this many assets. So based on that, okay, you are using the comparable method in this. So whenever you are using the similar type of transactions for evaluating your own business, that is what market approach. So price of a recent transaction or the price of assets that are comparable to the one being valued. You are identifying the similar kind of transaction that is present in the economy. Through that you are evaluating your own business. That is what market approach. So many times we do this. Suppose if I want to purchase a car, again, that is my second hand car. Now if I don't know what is the true value I need to pay for that car, what I can do in this, I will ask to other person, like I will ask my family members, I will ask my friends, that what is the true value of this car that I need to pay for this. So they can say that, Acha, remember that particular person, they also purchased a similar car. Okay, that is having this feature, that feature, and they paid only this much amount. So you also pay that much amount. So this is how you are making a comparison and then you are evaluating your assets. That is what market approach. You are identifying the similar kind of nature in the market that is already had the recent transaction, and then you are evaluating your project. That is what market approach talks about. Okay, this is your first type approach. Then next is your B1. This is your income approach. Now, income approach, when valuing a company, the income approach is utilized to determine the present or current value of the company's expected future earning or cash flows. So, basically in this, you are estimating the present, current, okay, or of the company's expected future earnings of the cash flows. Means with the help of company's present working or present earning, you are evaluating their future earnings also, and with this you are calculating their value. The company, if company is earning right now 1 lakh rupees, Hana, so you can estimate like after 1 year they can earn around 1 lakh 50, or they can earn around 2 lakhs. So based on your present or your current value of your companies, okay, you are of the company's expected future earnings or cash flows, you are estimating. You are estimating the value of your company. So this is about the income approach, in which you are seeing that company's current valuation, and with that earning you are evaluating their future earnings. That is what income approach talks about. So the net operating income of the company is determined using this method, and then figure it divided by then that figure is divided by the rate of capitalization. We have numericals also in this unit, but in this session we are not covering the numericals. We are understanding the theory part, that what is your income approach, what is market approach, what is enterprise value, what is your book value, what is this market value. Because again and again you are going to see this type of words, this type of terminologies in your upcoming units. So better to understand, better to remember these words, because again and again when you are going to see, you won't be won't be discussing the same terminologies. So income approach is what, in which you are using your current earnings, your present valuation, and then you are estimating your future expected earnings. That is what future income approach talks about. Market approach talks about the comparable type of a transaction which is available in the market, through that you are evaluating. Okay, then under income approach, in this you are utilizing to determine the present or current value of the company's expected future earning. With the help of their present earning, you are calculating the future earnings. Now, next is your cost approach. Now, cost approach is also known as asset based approach. This is also known as asset based approach, in which assets less its liabilities. So basically in this you are going to determine the value of the company with the help of the assets they are holding. As a company, they are holding land, they are holding machine, they are holding plant. Okay. So with the help of these assets, they are valuing business. This is what cost approach. This is also known as asset based approach. So this is the third type of corporate valuation method that you can use. Okay, first is the market, income and cost. Under market, you are using the recent transaction. Income approach, you are estimating future earnings. Then cost approach, in this you are using the assets for valuation. Okay, so these are the three different approaches to corporate valuation. Chaliye. Next, there are four primary methods that can be utilized for determining the value of the firm. First is your adjusted book value approach. Next is your stock and debt approach. Then direct comparison approach, discounted cash flow approach. In your module B, like we used to do the NPV now, we are going to use again in this module that NPV methods for the valuation. So these are the 4 primary methods that you can use for the value of a firm. How you can calculate the value of the firm? With the help of 4 primary methods. First is your adjusted book value approach, second is your stock and debt approach, third is your direct comparison approach, fourth is your discounted cash flow approach. So these are the 4 different types of primary methods. Okay? And after this we have different types of numericals. So let's revise it once again. What things we have seen in this unit. See, we understood what is the corporate valuation when you want to value your business. That is what corporate valuation. Now in this you have 2 types of value, your market value and your book value. Book value means what? Which you are going to value with the help of financial statements. That is the book value. Market value when you are seeing the market and as an investor how much they are ready to pay for your business. That is what market value is. Then after that, enterprise value, this is the sum. In this you are adding your equity and your debt, both the parts. That is what your enterprise value. Then we have a standard also given by International Assets Valuation Standard Committee. In this, they are responsible for developing international valuation standards, that is your IVS. After that, we have seen the 3 approaches of corporate valuation: market approach, income approach and cost approach. Under market approach, we talk about the recent type of a transaction. Under income approach, we are using your present incomes and we are estimating the future earning. Then we have cost approach, assets for valuation you are using in this. Then after this we have seen 4 types of primary methods. Number 1, your adjusted book value approach, then stock and debt approach, then direct comparison approach and discounted cash flow approach. Chaliye, now based on this we are going to solve few questions. Tell me, which of the following is not one of the 4 primary methods for determining the value of a firm? A, adjusted book value approach, B, stock and debt approach, C, market demand approach, D, discounted cash flow approach. Tell me. In this they are asking about the odd one out. So if you see, the odd one out is your market demand approach. Okay, chaliye, coming to the next question, that is the market approach to valuation primary relies on. In this they are asking about the market approach to value primary. They are using what? Company's book value, comparable transactions and market price, projected future cash flows, D, company's historical earnings. So in this, whenever you are going to see the market approach, they are talking about comparable transactions and market prices. That is what market approach talks about. Chaliye, now tell me, if a company's enterprise value is 500 crores and its net debt is 200 crores, what is its equity value? Everyone, please try this. So in this they are saying that if your company's enterprise value is equal to 500, your net debt is equal to 200, then what is the value of equity? So we already know one formula, that equity is equal to enterprise value minus net debt. That is 500 minus 200. That gives you 300. So correct answer is your option A. That is your 300 crores. And remember, this unit is very lengthy unit. So because of time constraint, we are not able to complete your full unit. But if you want to complete, you can enroll in our batches, and for that batches you can visit to Adda 24/7. Okay, as soon as you are going to type on search engine, any search engine you can use it, then you can visit to this official website, that is Adda 24/7. This is our home page. In this you can click on all courses, JIB, CIB, and CIB June 2025 is your attempt. So this is your bilingual batch and this is your English medium batch. But if you want to get the one solution for clearing, then you can enroll in CIB Mahapacks 2.0. In this, we are providing you all the online live classes, whether that is concept, whether that is your crash, whether that is your revision. So this is a bundle, in which with your one investment, you are going to get each and every classes of your 5 subjects, not only for 1 or 2, all the 5 subjects, then mock test for your continuous evaluation, then ebooks for your self-study, okay, then videos for your multiple revisions. So this is the ultimate pack which you can use it for clearing your CIB June 25 cycle. Now if you want to buy it now, you need to click on this. Then you need to use one special coupon code, otherwise your discount amount will only be 78%. But this can be increased by using Y895. Remember, as soon as you are going to apply this, your discount amount will be increased up to 80%. This is the benefit of using these special coupon codes, and along with this you are also going to receive double validity. So use this coupon code, otherwise your discount will only be 78%. And remember, if you purchase the same batch from Adda 24/7 application, you are going to receive 1% extra. Means total 81% off plus double validity on this pack. Apart from this, if you have any other doubt, you can ask me through the comments also. And if you like this session, you can press on like button and share with your colleagues about this channel. So thank you everyone. Now I am winding this session. Thank you for joining. Take care and bye-bye.